Elliott wave theory. Basically, Elliott wave theory is a technique of technical analysis to analyze and evaluate the financial market cycles and to predict the trends with the help of investor psychology, highs and lows in the prices, and other many indicators. This is one of the most used techniques by successful traders in the financial markets. This technique is named after Ralph Nelson Elliott, who discovered this market analysis tool back in 1930. He said that you can easily witness certain types of patterns in the market prices, and those patterns are called Elliott waves today. Historically, Elliott wrote his theory of market response in the book of Wave Principle in 1938. Later, this theory was summarized in a number of articles in Financial World magazine in 1939. However, major final work was published in Nature's Law comprehensively. He stated that because man is subject to rhythmical procedure, calculations having to do with his activities can be projected far into the future with a justification and certainty heretofore unattainable. The empirical validity of the Elliott wave principle remains the subject of debate. If we try to summarize the Elliott wave theory in simple words, this theory says that collective investor psychology moves between optimism and pessimism in natural sequences. These fluctuations in moods cause patterns in the price movement into a financial market. These movements are at a very degree of time and scale. In this model, you will see the prices fluctuating between an impulsive or motive phase and a correct phase on all time scales of a trend as shown in the picture. It is to keep in mind that you can divide the impulses into a set of 5 low-degree waves. Simultaneously, again between the motive and corrective character, so that waves 1, 3, and 5 are impulses. Waves 2 and 4 are lower retraces of waves 1 and 3. Corrective waves are subdivided into 3 small degree waves, taking start from a 5-wave countertrend impulse, a retrace, and another impulse. In a bear market, the prevailing pattern is descending, so the example is turned around 5 waves down and 3 up. Intention waves consistently move with the pattern, while restorative waves move against it. The examples connect to shape 5 and 3 wave structures, which themselves underlie self-comparable wave structures of expanding size or more significant level. Note the lowermost of the 3 admired cycles. In the main little 5-way succession, waves 1, 3, and 5 are rational, while waves 2 and 3 are restorative. This signals that the development of waves on 1 degree higher is upward. It additionally flags the beginning of the principal little 3-wave remedial arrangement. After the underlying 5 waves up and 3 waves down, the grouping starts again and the self-comparative fractal math starts to unfurl as the 5 and 3 wave structure which it underlines 1 degree higher. The finished intention design incorporates 89 waves, trailed by a finished remedial example of 55 waves. Every level of an example in a monetary market has a name. Experts use images for each wave to demonstrate both capacity and degree. Numbers for intention waves, letters for remedial waves, appeared in the most elevated of three romanticized arrangements of wave structures or degrees. Degrees are relative. They are characterized by structure, not by total size or span. Influxes of a similar degree might be of altogether different size or potentially duration. The grouping of a wave at a specific degree can shift. However, specialists by and large concur on the standard request of degrees. Surmise spans are given below. Grand supercycle. Cycle consists of multiple centuries. Supercycle, multiple decade about 40 to 70 years, or 4 to 7 decades. Cycle consists of 1 year to multiple years or even can have several decades under an Elliott extension. Primary, from a few months to a couple of years. Intermediate, consists of weeks to months. Minor, few weeks. Minute, consists of few days. Minute, few hours. Subminute, few minutes. Salient features of Elliott waves. It is worth mentioning that it is commonly believed by the Elliott wave analysts that each wave of Elliott has its own specific features or signature. These waves typically tell the psychology of the moment. It is inevitable for you to understand these features in order to implement Elliott wave theory successfully. These features and definitions are being explained here and below. It is to keep in mind that definitions assume a bull market inequities. Reversely, characteristics are applied in reverse in bear markets. Dominant trend, 5-wave pattern. Wave 1. You will rarely witness the wave 1 at inception. The basic news is almost negative across the globe when the first wave of a new bull market starts. However, the previous trend is assumed still strongly in force. Moreover, fundamental analysis experts keep revising their earnings estimates lower. However, the economy may not appear strong. Sentiment surveys are decidedly bearish. Put options are in vogue, and implied volatility in the option market is high. Volume might increase a bit as prices rise, but not by enough to alert many technical analysts. Wave 2. Wave 2 rectifies Wave 1, yet can never reach out past the beginning stage of Wave 1. Commonly, the news is still terrible. As costs retest the earlier low, bearish notion rapidly constructs, and the group haughtily reminds all that the bear market is still profoundly hid. All things considered, some sure signs show up for the individuals who are looking. Volume should be lower during Wave 2 than during Wave 1. Costs normally don't backtrack over 61.8%. See Fibonacci area underneath. Of the Wave 1 gains and costs should fall in a 3-wave design. Wave 3 is typically the best and most impressive wave in a pattern, albeit some examination recommends that in bear markets, Wave 5 is the biggest. The news is presently certain, and basic examiners begin to raise income gauges. Costs rise rapidly. Redresses are brief and shallow. Anybody hoping to get in on a pullback will probably miss the boat. As Wave 3 beginnings, the news is likely still bearish, and most market players stay negative. Yet by Wave 3's midpoint, the group will frequently join the new bullish pattern. Wave 3 regularly expands Wave 1 by a proportion of 1.618 by 1. Wave 4. Wave 4 is regularly, obviously remedial. Costs may wander sideways for all-inclusive period. And wave 4 regularly remembers under 38.2% of wave 3. Volume is well underneath that of wave 3. This is a decent spot to repurchase a draw in the event that you comprehend the potential ahead for wave 5. All things considered, fourth waves are regularly baffling on account of their absence of progress in the bigger pattern. Wave 5. Wave 5 is the last leg toward the predominant pattern. The news is generally certain and everybody is bullish. Shockingly, this is when many normal financial specialists at last purchase in, just before the top. Volume is frequently lower in wave 5 than in wave 3, and numerous energy markers begin to show divergences. Costs arrive at another high, yet the pointers don't arrive at another pinnacle. Toward the finish of a significant buyer market, bears might just be mocked. Review how conjectures for a top in the securities exchange during 2000 were gotten. Corrective trend, three-wave pattern. Wave A. Corrections are normally harder to distinguish than motivation moves. In wave and of a bear market, the central news is generally still sure. Most examiners consider it to be as a revision in a still dynamic buyer market. Some specialize pointers that go with wave and incorporate expanded volume. Rising suggested instability in the alternatives markets and potentially a turn higher in open revenue in related prospects markets. Wave B. Prices turn around higher, which many see as a resumption of the now a distant memory buyer market. Those acquainted with traditional specialized investigation may consider it to be as the correct shoulder of a head and shoulders inversion design. The volume during wave B should be lower than in wave A. By this point, essentials are presumably done improving, yet they do not doubt have not yet turned negative. Wave C, prices move indiscreetly lower in 5 waves. Volume gets, and by the third leg of wave C, nearly everybody understands that a bear market is immovably settled in. Wave C is regularly in any event as extensive as wave A and frequently stretches out to 1.618 occasions, wave A or past. How to recognize a pattern. Elliott's wave hugely depends upon the price charts, and you make decisions by looking at the price charts into a market. Most of the traders seek help from the developing trends in order to differentiate between the wave and wave structure. This enables them to predict the future price. So, you can easily say that pattern recognition is a crucial part of Elliott's wave principle. The structures Elliott depicted likewise meet the basic meaning of a fractal, self-comparable example showing up at each level of pattern. Elliott wave